Cool. All right. Hey, it's 7 p.m. Thank you for being the super prompt ones. We are definitely going to kick off. Just want to check, if you have any questions, bit of admin at the beginning. So anything you want to ask, please pop in the Q&A box in that chat, and we will come to the questions at the end. So we'll see how the time goes. We want to keep this to around about an hour, but fear not, if we don't get to immediately answer or address your question in the chat after the core content, then we will definitely answer them in an email that will be followed up with you tomorrow, along with the replay link. So appreciate this time, especially if you have kids, your parents. It's a little bit tricky sometimes in the early stages, a bit of overlap there, so you can replay this for sure. But first of all, just want to kick off and say thank you for joining us, and very special thanks to Cameron Bagrie, independent economist, director of Bagrie Economics, who has come all the way up from Wellington specifically for this tonight. So thanks for joining us.
Nice to be here.
And tonight we want to bring you something different. So obviously look at a cash flow hack example, very impressive 27-year-old couple that I've been working with for the last year, who have completed not one but two cash flow positive cash flow hacks in central Auckland, by the way. No small feat, but definitely achievable, and feel as though it's the right time to have someone like Cameron Bagrie come and talk to us about the bigger picture. I have this tendency to focus in on the strategies and the projects and the markets that myself and my clients are operating in, and we need to zoom back from time to time. In terms of the overall climate, it's becoming more positive for our strategy to add value, to cash flow hack, add bedrooms, increase gross return and servicing. Certainly top of mind for the banks is your ability to service and also usable equity in order for you to keep moving forward. And that's what we're all about. We're not here to wait for natural market growth. We have really aggressive goals. That's why you're here. So we're here to get another perspective from yourself and look at, first of all, a little bit of chit chat about the economic environment in general, which Cam records as a weekly update on the market as well as property market. I'm just going to go share screen here, and just 1 second, and then we'll kick off properly. Just move this here. Awesome. The property clock is ticking. So if you've not heard about this concept before, we're really excited to have you here, Cam, to take us through this, to add value or get left behind. So everything is about timing and time in when it comes to buy and hold, which is what we are exclusively about. Just want to check here. Cool. Just a quick disclaimer. So the examples tonight are an example of a real case study and real purchasers, investors, but this is not personal advice, but you will have the opportunity at the end to book in to have a discussion with myself in the coming days about your situation and how this example and the methodologies that we can help you achieve together might work for you. Welcome, and I'll let you do a little intro about yourself, Cam.
Worked for a bank for an awful long time, chief economist for ANZ for 11 odd, sort of 12 years, running around the country like a bloody headless chicken. It was an awful lot of fun when you're in your 30s and your 40s, but you get a little bit older and all of a sudden you sort of want to slow down and have a different part of life. So I've been out there at the moment running what's called Bagrie Economics. I've got some pretty strong property investments myself. I've got 3 directorships, 2 other businesses that I personally run. So much for sort of slowing down, but it's a fair bit of fun. But yeah, what I've got at the moment is that I've got touch a whole lot of different fields, and probably one of the best ones that I really enjoy is Life Education New Zealand, which is one of my giving back things.
Awesome. That's really cool. I think that's why I really have been excited to bring you to this audience, because you have such a well-rounded approach. You're thinking about the economic factors, giving back, and also property, kind of how it sits within the broader context of what you do. So very excited to hear your input and your expertise. So one thing that, interesting fact about Cam that I have only learnt more recently through spending a bit more time with Cam, is that you were the youngest chief economist of ANZ, and for 11 years, also right through the GFC, which I found super interesting because that's when I started investing as a part-time investor. And that time, so 2007 right through to 2010, in fact, is like such a visceral time, which I'm grateful now was that learning platform. But oh my gosh, being chief economist of the largest bank in the country, navigating through that.
Oh, but
Is it a blur? Do you have memories?
I can still remember the phone going off late in the evening, or should be early in the morning, in regard to what was going on there. The other one, which is 9/11.
Yeah.
When we went through that,
Oh,
God,
wow, yeah.
all of a sudden, I'm like, oh God, the phones are ringing. What the hell do we do in regard to this? Buy every bloody bond you can buy, all this sort of stuff. But it was fascinating times to work through. Now the thing is, look, if I go back and have a look at what I learnt the most from, you learn the most from your toughest times,
100%.
right?
100%.
So I can remember when I was a teenager in the 1980s, and I had quite a bit of money tied up in RADA, Ariadne, and Briley, and all these other bloody companies, and I thought at that stage I knew what I was doing. I had no idea what I was doing, right? But I'll tell you what, when you lose a lot of money as a teenager, by Christ, you learn.
Yeah.
Right?
Well, it forces
resets
you. Yeah. Well, you have that pain, right? And then that's so similar to my early years trying to renovate and just work it through and do things terribly. And then us having to move out of our family home for a couple of years to actually course correct and fix all the cash flow hemorrhage. Nothing teaches you to problem solve like an experience like that. But so extreme wealth of knowledge. So do pop your questions in there. We are. Oh, and a little bit about myself. So I am the director of Wolf Property Coaching, have been investing in real estate for almost about 19 years, actually full-time for nearly 10, and coaching for about 5 years that's coming up, which is very exciting. Have this trademark called cashflow hacking. Effectively looking to buy existing builds and educate my clients to replicate and shortcut the results that I've created for myself and my family, but without having to go through all the peaks and troughs of what I learned in those earlier years especially, which is what Cam's alluding to. So I've evolved to about a $20 million portfolio and finally becoming really active for myself now. Have really focused the last 3-4 years through these sort of tougher I guess as property investors, the tougher few years really focused on helping my clients get established, and now they're really humming. So have been on radio station, a few podcasts, magazines. You've probably heard some of that. Tonight's agenda, we are firstly going to hear from Cam. He runs a weekly update over Teams with his subscribers, which we'll talk about again at the end. His insights as to what the international triggers are and local, influencing the local New Zealand economy, which you definitely want to consider as that macro market view as property investors and owners. And then we'll swiftly move into his property market insights. And then really the crux of what is going to be the key tool that you take away from him tonight as property investors is his property clock, and how you can reset your thinking about the different quadrants and times of the clock. We'll talk about where we are right now, and coming back to that idea of add value or get left behind. Really, this is about the timing for the strategy, and you're here to hear the examples and see how client accelerators have really nailed the cash flow hacking brief. But what are the benefits that come after the immediate deal? So what are you looking for, whether it be increasing your servicing to buy the next property, increasing your usable equity to leverage into the next one? Neither of these achievements can be as fast as with this strategy. If you're waiting for the natural market to move into your next property, it will otherwise take a lot longer than following the rules here. So we'll go through that, and then a little Q&A at the end. So I thought I'll stop sharing screen and we can just have a bit more of a chat. So in terms of New Zealand market, we'll move into the property market in a second, but what are some of those updates that you've been really covering in the last few days with your weekly roundup?
Well, you take interest rates down, the economy is going to pick up, and it's pretty obvious at the moment that the economy is picking up. Is it going to be what we call a historical cycle. And by history, I guess a lot of people tend to benchmark their playbook over what's happened in the past sort of 10, 20, 30 years. And if you go back and have a look at the past 30 odd years, your house prices typically in New Zealand have gone up around 7% per year.
On a long-term average, right? Last 30, 40 years.
Right.
Yeah.
But, and it's been a great story. And the problem is income's been growing up at 4 to 5, right? So when you get one growing at 50% in excess of the other, you get into what's called an unaffordability crisis.
Right.
And you start seeing real tension between the buyers and the sellers, young versus the old and that sort of stuff. So one of the things that been out there sort of telling people at the moment, look, the property market, we're going to see an upswing in the next sort of 2 years. Yeah, but you'd be baking in 5% sort of growth, something in line with income growth, as opposed to that sort of traditional, look, normally when the market goes nuts, right? And you might get 10% plus.
So how has that been the case over the last few decades when, if that sounds like absolute logic, so does that mean that historically incomes did increase more closely aligned to that 7? Or how did that occur over history for such a long period of time?
I think a lot of what took place was that, over the course of 20 to 30 years, we saw a long-term trend decline in interest rates. Right, so you go back and you have a look at our parents' generation. And our parents' generation, it used to sort of double-digit mortgage rates, whereas we used to single-digit ones. Right, and we saw over the 90s, the 2000s, that the trend was basically down for interest rates. They go up, but then they're down. But they were lower on average. And what that allowed people to do was just to leverage more. Right? When you can leverage more, of course, you're going to see house prices that are going to outperform. The issue at the moment is that, are the fundamentals in place for that sort of cycle again? I'd say no. Are the fundamentals in place for the property market to do pretty well? Certainly with interest rates coming down, but interest rates are not going back to the levels we've seen 3 to 4 years ago.
Yeah. So when you talk about the fundamentals, are they in place for that to continue? You say no. So what fundamentals are we missing, or what's not there to support that?
Well, you've got a fundamental valuation problem at the moment in the first year. New Zealand house prices to income, it's not cheap. Right, your rates bill is going up at a double-digit rate. Your insurance bill is going up at a double-digit rate. So I've got a number of investment properties, and it's pretty tough to make the numbers stack up. Right. So what do you need to do? You need to add value. Right. You can't just buy and hold. And think that this thing's going to take care of itself. You've got to add value, and you've just got to extract more revenue income out of your portfolio going forward to make the numbers stack up.
What ways have you added value in the past?
One of the places I got down at Wairariri just put on a secondary unit. It was a bloody undertaking, I can tell you that. But you're putting you're looking at working with the council in regard to what's allowed. Right, but I was allowed to put on a secondary dwelling, another 2-bedroom unit. So all of a sudden, you don't just have one income generating asset on the property, you've got two.
I think in terms of, I talk about this a lot with my investors as well, is having that, just trying to even this out for us, is having those 2 bites of the cherry. So kind of having that immediate cash flow hack or cosmetic renovation to boost the gross return through improving the rents, adding equity as we go. But it is exclusive to existing builds having the land, right? And working with the planning rules and the district plan of the council district your property is located within, and working out how you can intensify. So it's not just about subdividing, but perhaps you're already permitted to have a second or third dwelling. And overall, the trend is with the government mandate to improve intensification is that adding dwellings without having to go through, I would say, a longer process of needing to subdivide is becoming a little easier, over time than it has been. But
same thing. It doesn't matter whether you look at the residential or the commercial market. So if you look at even commercial property at the moment, you're seeing massive segmentation where quality counts. Because people will pay for a good quality, sustainable building that's environmentally friendly, all this sort of stuff. So there's been a big difference in regard to what we're seeing in regard to the pricing between what's called A-grade stock versus your B, C, E, D. And the same thing I think is going to happen within the residential market.
Yes, and it should, because our overall standard has been so poor historically. Like healthy homes is a really good nudge in the positive direction. But when I talk to investors and friends who have properties overseas, those markets from a regulatory point of view are so far advanced. If you look at the UK and Europe, those efficiency ratings and alongside square metre or foot size, those factors play heavily into the value, whereas we don't really see that stratification here. But I think it's better to be proactive, and through adding value and improving the dwellings, we're already moving in that direction, because not doing that is only going to require you to catch up later, right? If you don't improve the property.
Oh, eventually you get pinged.
Yeah. Cool. So in terms, I'm sure everyone here is really interested to hear your take on interest rates. Next OCR is next week, 9th of April, week out from now. What's your take on where interest rates are with respect to property investment now? What are you seeing for the rest of the year? What are the factors driving your view, and what do you think you're going to see?
But people need to differentiate, I guess, between what the Reserve Bank does with the actual OCR versus what they signal. Yeah. So if you ever look at a 1 and a 2 and a 3-year fixed mortgage rate, that's not based on the OCR that we see today. It's based on the expectation of what the OCR is going to be in the next 1, 2, 3 years. So what we're already seeing within those fixed rates is the expectations that the official cash rate is both come down, but expected to go down a little bit further.
Yeah.
Right. And a number that I keep telling people to keep an eye on is what's called the neutral OCR. And the neutral OCR is where the Reserve Bank has neither got the foot on the accelerator or the brake. You think of it when the Reserve Bank's having a damn good holiday up in Thailand. And that number's around 3.
Okay.
Right? So the official cash rate at the moment's 3.75. Now, the market is saying the official cash rate's going to go to around 3. And that's one of the reasons you're starting to see these fixed rates with a sort of a sub 5, low 5 sort of number about them.
Yeah, 4.99, 1 year.
You add on a couple hundred basis points on top of where that neutral sort of rate is. So I don't think we're too far off what's called the trough in this interest rate cycle. Right, so
in terms of pricing or timing?
Oh, both.
Yeah.
Right, but if the New Zealand economy goes to hell in a handbasket, well, the official cash might go to 2. Right? And if it goes to 2, then you're going to see interest rates down around 4. Yeah, but at the moment it looks like we're going into what's called the glide path.
Yeah.
Smooth landing. Official cash rate goes to around 3. Fixed mortgage rates already anticipating we're going to be around 3. So you're starting to see those deals and a little bit of competition amongst the banking sector at the moment.
Yeah, coming back.
With the high 4s in front of them. So that's probably not too far off as good as it's going to get, I suspect, this cycle.
What are you thinking in terms of timing for that, if it's sort of minus 50 to 75 points? If we come down towards that 3, is that over, do you mean immediately the next 1, 2, 3 OCR reviews, or are you thinking sort of through 2025 there'll be a gradual glide path landing?
I think they'll go again. They'll go again in April. If it was me, I'd be probably a little bit more patient. I'd probably step back a little bit, but financial markets are basically saying we're going to get to around 3.25 in the next 6 to 12 months.
So for a 1 year rate, which is sort of the key indicator, a lot of Kiwis go for that 1 year, where do you think roughly that translates into as a retail 1 year rate? Well,
we're starting to see those rates at the moment. They're basically, the 5's like the magic number. Right, so I have a look at
I'm not that excited by if that's the bottom.
but if I have a look at what I try to do with my stuff, I try to have an average cost of capital that's below 5.
That's a good point. What does a head economist do? So tell us your strategy.
I was lucky enough that I was in donkey deep and 4.5 years ago in a 299 for 5 years. So
which we're all lamenting. We wish we did.
But there was a brave call 4 to 5 years ago. Because at that stage you were getting a 1 year rate at 2.2. Whereas the 5 year rate was 2.99. It was like, well, hang on, there's a 70 basis point difference, 80 basis point difference between one versus the other. But I took the more expensive rate and it's paid off over time.
Which is crazy because it's all relative, right? So 2.99 seemed so high relative to the 2.19 or 2.25, whatever it was. Lose sight of the fact that all of those are ridiculously low in terms of the long-term trends, right?
Oh, well, one second, you go back and you talk to our parents' generation, right? And they laugh at us in regard to...
They can't believe it, yeah.
How good is it, right? But yeah, as I sort of tell the parents' generation, well, property prices weren't as cheap.
Totally.
Right,
And that's the thing. I think, quite often I'll meet with new investors and they're talking about interest rates and like why, what's a bunch of reasons for either why they should invest now or hold off, what are the perfect conditions? And, if you're already investing, there are none. It's about having an appropriate strategy, which we'll dive into in a second. So, we can't control the interest rates. We have no individual influence over that. It's one of the biggest drivers for why I'm very passionate about gross yield and cash flow, which we'll come to see shortly. So we'll jump into that. And that's the thing, we can't control those things. So it's how do you work with the environment and the facts and keep moving forward towards your own individual goals. So with that in mind, talking about different strategies and stages of the cycle. So Cameron has created this model, which is the property clock. Do you want to give us a little overview of it? We're about to ask you a question very shortly about where you think the New Zealand property market is at with respect to the clock. But would you like to give us just a sort of the general overview? We'll go into the nuts and bolts in a second, but what's the concept here?
Yeah, well, look, everything works in a cycle. Right? And what people tend to focus on within the property market tends to be house prices. But yeah, house prices, in my view, tend to be a little bit of a secondary, a lagging indicator. You've got to look at a whole lot of other indicators that give you a prelude in regard to when the market's going to start to move.
Yeah.
Right, so yeah, if you look at REINZ, there's a whole lot of information. You've got days to sell, you've got volume sold, you've got the gap between, compared to valuations. There's a whole lot of different indicators that you can use to provide a bit of a schematic in regard to where does the market sit in the cycle. Yeah, so we just an example, right? So if you look at days to sell, right? Days to sell, average, let's say 35, 36, 37 days.
Yeah.
Right?
Yeah.
Now, if that number's 40 to 45, right, you've got a market where you're not going to be seeing price gains.
Right? Yeah, it's not in favour of the vendor.
No, it's not.
Yeah.
Right? But if I tell you that, that the market has gone from 45 to 40, right, that's actually a market that's improving, but it's still a market that's still weak.
Yeah.
But directionally, there's been a very clear change in regard to what's going on. Yeah, you might be seeing very slow volumes sold across the market, but if the volumes sold across the market are higher than what they were 2 months ago, you've got the signs that the market's starting to turn up. Right? And the key here is to track these indicators so you sort of know where you are within that sort of 12 digital clock in regard to what's going on.
Okay. We'll do a little test then, and then we'll bring up the details, actually. That's a great point. So I am going to bring up launching here. We're going to run a quick poll. Hopefully that's popped up on your screen. Where do you think we are in the property clock? So we just had that up. I'll see if I can share screen, actually. Just keep that there for you. Just make sure that poll's still running there. Cool. Just give you a few more seconds. Hopefully that is still showing. I'll just, I'll just stop share just in case. So, here we go. Okay, in 3, 2, 1. Ooh, okay, what do we have? So we have 86%. Okay, we'll start from the top. So I'll bring up the diagram. Actually, I can't see the poll if I do that. So I will share these results. Can you see this? So are we in the slowdown and slump? Very, very minor answers there. Are we in the boom? You're all very astute. We're definitely not in the boom. So 86% of attendees here have said we are in recovery. So 6 to 9 p.m. Awesome. Great work. Okay, so I'll bring this up again and we'll continue that conversation because this is probably the slide that you're all wanting to have a look at. So I think, to frame this and going into the case study shortly, do you want to talk about, where we're at? I feel is a great place in terms of the strategy, lending conditions, government regulation for existing builds, which is what we focus on. We've come through this, what's the timeline? 2-3 years up until the last 6 months, I would say, where the favour was for new builds. We had, from a regulatory point of view, the interest rates have been extremely high. How would you frame the last sort of stage? What were we seeing with respect to these indicators, and how do we know that we've moved on from there?
I reckon there's two stories here. Look, story number one is just step aside from the cycle and just acknowledge that, the market has changed, right? And I don't think we're going to see 7%, house price growth every year for the next decade. Right? The new normal is 3, 4 or 5.
Is that, you mentioned the income ratio before. What about COVID? Do you think there's a before and after COVID? Am I being too dramatic? But just in terms of icy flow, population.
I just think, the house prices are now at a bit of a pinch point, and you've got government policy that's very clearly aimed at making sure we don't let this thing behave like a runaway train again, which I think socially is a good thing. What does that mean? Is that as an investor, you just got to be focused on adding value, right? There's nothing wrong with the market. The market will still work for people that are adding value, and then you've got to work within the property clock in regard to what's going on with the cycle, right? And this is looking at your days to sell, your auction clearance rates, the volume sold, and working out. And if not everybody's a trader, but if you want to be a bit of a trader, you can sort of play a little bit of game here in regard to what's sort of going on. Because it does. We do go through those evolutions, and it's very clear at the moment that the market is starting to pick up. It's coming off a low base, but if you look at auction clearance rates, if you look at foot traffic going through, if you look at days to sell, if you look at volume sold, the market is starting to pick up. Does that mean the market's strong at the moment? No, the market's not strong. But momentum is starting to build, and we're just going through another phase of that cycle. It'll take I think we'll be in this phase for probably another 12, 18 months.
Oh, that's a good point. Okay, so 6 till 9 p.m. we're talking about, we're in recovery. So largely you're saying this year is all about recovery and more positive indicators. So the indicators for 6 till 9 p.m. Strengthening evidence, is that right, of those indicators? Would you say, is that accurate?
So we're very clearly seeing it, but it's taking a little bit of time to what you call self-populate in regard to what's going on, and we're still not seeing it within the pricing gauges. So if you look at house prices at the moment, house prices are not doing too much, right? But if I look at the lead indicators, your days to sell, your auction clearance rates, your foot traffic, that sort of up. Starting to see a little bit more investor activity as well.
A few multi-offers, a bit of wholesaling, all right? So we talk about flipping and trading property. So someone who picks up an agreement, a contract on a property. I think in New Zealand, we typically think of this as renovating to add value, then flip. But actually what I've been seeing for the last 6 months and with my clients is there's a place in the framework of the industry where those that have a higher risk profile, have access to capital, they're probably cash buyers or have a revolving credit, are turning over properties by wholesaling. So in the US, it's known as wholesaling. So effectively, you're flipping the property or the contract to someone else. Because you're a cash buyer, you're kind of, buying from the sellers from that 4, 5, 6 o'clock, right? You're buying off those vendors who are, I've held on as long as I can. I'm selling, seeing a lot of activity like that where they will secure a short-term conditional contract flip that or wholesale that. So even with a buyer, which might be myself or my client, still makes sense, and we're still paying a really good price below market on top of the other contract and flipping that way. So when I start to see that activity, which we are, that tells me we're moving towards 7. Yeah. And then, of course, adding value to flip or hold, we're right into the heart of that as well. I feel as though, our clients have done so well, despite the slump sounding quite negative. These examples are literally, that we're about to jump into, are from that 4 and 5 o'clock, and I think there's that media and rhetoric there that you can't add value or you can't make money in the property market in this stage. It couldn't be further from the truth. It's I genuinely feel that adding value, and the evidence we've seen through these hundreds of client renos over the years, is that you're creating like a risk buffer. That's how I think about it. If you add value, it goes from 500 to 650 or whatever. If it comes back 10%, it's the value that you lose as opposed to the hard cash or the deposit you put in, where that's different. If you buy a property to not renovate, or you buy a new build and you don't add value, market comes back by 10%, your cash that you have worked 9 to 5 for all year, that's what disappears. So it's still relevant, and I see you've put that in 3 to 6, so I strongly agree. And these results we're about to show you actually are from that 4 to 5 p.m, which is really exciting because it shows you what is possible and the strength of, the whole thing, add value or get left behind. So, wanting to take advantage of the upswing and the positive indicators. Is there anything you wanted to add? Sorry, actually, just before we go into there. So what are we expecting to see? That's probably the key thing. So if we're, someone sitting at home tonight, they're joining in, they're looking at this clock, they want to buy to cash flow hack, add bedrooms, create value, add cash flow. What are those benefits compared to if they don't?
Well, once again, I'll just go back to step away from the cycle, right, and just appreciate we're in a different economic environment where you need to add value, right? And it doesn't matter whether you look at residential, commercial property, or you're looking at, I know equity markets have been wobbly over the past few weeks, but the quality will always count within your portfolio, right?
And differentiating, right?
So there's a strategic theme that people need to appreciate beyond the cycle. But there's also a cycle, right? And people like to play the cycle as well in regard to what's going on. And we are we're in that uplift phase. But that uplift that we've seen historically has been, when the property market goes, it can go 10% in a year. It's like Christmas. To what's going on, if you're leveraging and that sort of stuff. The fundamentals don't support that. That doesn't mean that we couldn't have that sort of an upturn, because the property market, can take on, a mind of its own in regard to what's going on. But I keep coming back to the economic basics and just, focus on the quality within your portfolio. And it's, people, I think, are failing to appreciate how much it's becoming more difficult with your rate increases, with your insurance increases and that sort of stuff. And you've just got to have a lot more quality within your portfolio. Look after your tenants. Right? Make sure they've got a value proposition in front of them, because they'll pay.
This is the thing, right? I think differentiating always has value, right? A commodity has less value, particularly with the rental market. If you can differentiate, you can assert a different rental value, property value, because you're not a direct comparison to a property that if it is identical and your neighbour is in a distressed situation, they sell, and your value or your rents are dictated by their situation. That's relinquishing control to someone else. Adding value to force higher value or rental value as a way to differentiate and compete against a really average rental out there, and there are so many of those. And that's the other thing I'm really passionate about, is adding bedrooms, because it often brings together families that are often split across different places, older children having smaller children from a second partnership, and then creating healthy homes that are affordable with additional bedrooms. Sometimes sleep outs as well. It brings back together people who are otherwise, for one reason or another, forced to be apart. So I get quite passionate about that as well. So we'll just quickly race through a couple of definitions here, just to make sure that if you're a new or aspiring property owner, Just to really be clear about these things. So deposit is either cash or leveraging off a certain property asset to purchase another. And so that is your contribution or your risk going into a purchase that the bank will help you ideally put the 70% value of a new purchase with them. Gross yield, and to be clear, for the purposes of how we think about this with cash flow hacking and with Wolf Property, it's about creating a strong post-renovation income. So that's annual income divided by the debt. Now, most property investors, especially with an active build phase, looking to leverage one property into another, quite often that is entirely with debt. So that's a full purchase, a full deposit, and the renovation can all be debt. And it's often represented as a percentage. So the way that our services accelerate in boardroom, talk to the market and you, I guess, is that we think about 8%. So post-renovation rent per annum created through a really effective renovation spend and method divided by the total debt is how we think about it. I'm obsessed with hardworking debt, and the example tonight is about rent investors. And that's not necessarily saying that if you're not a rent investor, these examples don't apply. It's just a different way of, it's a different concept. We thought we'd put it in here to switch things up, because we normally talk about those who leverage completely over debt on their home into their first investment property. So this is going to show you a slightly different way if you're yet to buy your first property. Equity is the difference between the value of an asset or a property, in this case, less the debt that you owe to your lender or the bank. That is your net asset, effectively. Capital gain, this is the increase in value, which could be either through that organic market uplift over time. For our purposes, we are trying to push and force appreciation of that property's value between 5 and 7 weeks, depending on what the property is, what the renovation required is, but as fast as possible. The objective here is to jump ahead of the natural market growth. But from what Cam has already been explaining, we're moving into a positive territory that is hopefully going to be a bit more of a tailwind rather than a head, which is what we've had the last few years. And the most important thing for cash flowing, which is what we're obsessed with here, and all my investors and clients, is about controlling and creating really strong gross yields after renovation, because we can't control interest rates, but we can opt in to the type of property and the outcomes that we create. So that's a personal choice. So I'm very passionate about helping my investors create cash flowing properties. And this is exactly what is happening, and with the examples we'll just go through now. So just also to clarify, do you want to talk about test rates, Cam, versus lending rates? So lending rates are the rates that you see as borrowers. What is the difference? What is a test rate?
The test rate is just hypothetical sort of rate that the bank will use behind the scenes to assess whether you can afford a loan.
Internal rates, right?
Yeah.
We don't see them.
No.
Yeah.
And yeah, well, the confusing thing about the test rates is that they move over time. So that they tend to move with the actual interest rates. So when interest rates move up, of course the test rates move up, and it becomes a little bit more difficult to get a loan, because banks are not going to be assessing your ability to service a loan based on the actual rate. They'll be assessing your rate based on the test rates.
And stress testing you as your personal situation, correct? Yeah.
What we're seeing at the moment is, test rates are starting to come down.
Yeah. Awesome. All great stuff. Awesome. Okay, so taking all of that context and wrapping that into these awesome examples. So we really are here to show you how, and these two properties are actually almost like for like. So we're going to focus on the concepts, how moving forward, so you don't get left behind, is the key outcome. And we'll go through in quite a lot of detail here. The first one, which is in Otahuhu in central Auckland. What is cash flow hacking? So this is the method which is basically where I help clients identify. The best way to illustrate is if you have a 3-bedroom house you're looking to purchase, let's say you park that up alongside another one based on a whole bunch of things that I help my clients look for, may be able to be converted into a 4-bedroom, maybe a 5. Basically, if we can get more value from renovating and creating bedrooms, then in 5 or 6 or 7 weeks, that is going to add value on the rental market as well as value to your property. So that's where we're adding the actual equity and value to the property, as well as improving the value of that as a rental on the market when you go to look for your tenant. Just a really brief snapshot of why this is so compelling and why it's so suitable for this time in the market. If you look from the top to the bottom, the bold, renovate and cash flow hack, this is where all of these strategies and what I teach my clients is all focused on. We don't look at land of its own right. We don't look at new builds or properties that can't be improved, because we need to, we're trying to manipulate an older build. It doesn't have to be the worst build. It just needs to have an opportunity so that you can get benefits from it in order to grow your portfolio and move into your next one. So I call this the sweet spot of investing, time and cost efficient, ideally no, but sometimes low red tape. So what does this mean? If the location of that property is a rental, really needs a second toilet, when you convert it from a 3 to a 4, we will look for a building consent from council. So everything is done correctly and to the code. We're trying to look for the raw canvas, if you will, properties that don't need aren't complicated, and we're looking for these cosmetic or superficial additions. Just to paint a bit of a picture, when you think about the context of the results of the added value to the upcoming example, this is a little canvas of the average New Zealand salary by industry. So, 52 weeks, look at the different professions here. We're going to show you how after a 5-week reno here, there was a significant wealth increase through what these young investors implemented or, renovated on this property. Won't go through this here. Cash is king. This is all what we're all about. Capital gains doesn't pay for the groceries. I'm going to show you two different charts. This property here, when you buy a 3-bedroom house, an existing build that you don't renovate, or you buy a new build that, again, you can't add value, right? Because it's so new, you can't change it. We are still seeing, with current rates, negative cash flows. And so that is quite typical. And so what we want to do is move further towards a neutral and positive cash flow. And certainly with the rates right now, this is what we are achieving. This is going to help support your incomes, your personal incomes, your overall servicing picture, in order to get another approval from the bank. And they're going to weigh up your income against the other lever, of course, which is what is your equity to leverage as a deposit. So cash flow hacking is not buying the 3-bedroom house and getting 3-bedroom rent. That is market return. You're paying full price and you're getting the commensurate amount of rent. Cash flow hacking is manipulating a floor plan, and we are looking for the houses where there is opportunity to repurpose certain spaces. We're not extending the house. We're not looking for hefty consent requiring works. We are looking to convert it and add bedrooms to make it worth more on the rental market. So that left-hand table moves into the right, and these are the actual cash flows on the right for this example. Now, I'll just briefly stop here because it would be really interesting to understand kind of where you're coming at this, looking to learn from this example. I'm just going to pop in here. What is it that you're looking for? It'd be good to know who is looking to create usable equity and who is looking to create cash flow and servicing to support your next move. Just give you a few seconds here. Oh, interesting.
It's quite clever.
It's cool, hey? Wow, that is a stronger split than I expected. 3/4, so 76% looking for stronger servicing and income. Okay. That is quite interesting to me, given the fact that property values will come down through that stage of the property clock where values have been decreasing, equity has been hit, but looks like we've got an aggressive bunch looking to lend. Okay, so in the poll and share results, over 3/4 of you looking for servicing. This is awesome. Wow. Okay, perfect. Let's jump in. Okay, rent vesting. So again, whether you are looking to buy an investment property and leverage your home, awesome. The concepts are the same. Just to kind of contrast what we've looked at in the end of last year's webinars, we thought we'd use this as an example, because through a rent vesting approach, this young couple decided to keep renting where they live and where they want to live, and they decided to pop their deposit cash into an investment property first of all. And because of that, change in action or that distinction, their ability to achieve a positive cash flow. So rent comes in, costs and mortgage go out. They are making money in pocket with their central Auckland properties. Effectively, that's the definition. So keeping renting and then using your your cash as a deposit into a property, a rental property. And what this means is that you're not buying an investment property with all debt. You know, if you're popping in 30% as cash, this is reducing the amount of debt, and it's helping reduce costs so that that rent, especially after adding a bedroom, is going to be stronger and help you towards a positive net cash. To illustrate this, I'm going to, just for sake of time, I'm going to pop this full chart up here so you can look at the contrast. If we sort of take that 200K cash, which is the example that our clients have here, rather than pop that into their own home, which is the middle column, that would have been a 20% deposit. They would have bought a $1 million property, $800,000 of loan. Let's say that interest rate was 5.5%. The mortgage cost relies on them paying that mortgage, right? Because there's no income coming from that. So therefore, their outgoings to support the mortgage is $44,000. But based on the right-hand side scenario, where the 30%, that becomes a 30% deposit for an investment property, that buys the $730,000 rental we're about to go through. That derives some income, as you can see, and then remove the mortgage costs. Their gross cash flow is positive. The $56,000 is a difference between those two scenarios. So you start to see a major impact. And, you know, the concept here is, it's about the concept. You know, this example you can apply to, you know, you possibly have a rental property where you're thinking, hey, I really want to get it out of the red into a positive cash flow, get it into the black. How can I apply this idea? So think about this if you have a rental as we go through. What these very astute young, this couple bought was often what can be quite challenging or off-putting to first-time buyers, right? Or to anyone. There's higher risk when you find a property in this kind of state. It was an owner-occupied property. They had their son in there, just not looking after it. They were absent as parents, and this son just did not look after it, had no real responsibility. But therein lied the massive opportunity that my clients and myself could see to improve. And you can see there are these very generous spaces. What you're looking for is an optimal layout, a layout that allows you to think, okay, well, if I need or want to add a bedroom inside this current footprint, how or where can I do that? There are a whole bunch of considerations, of course, because you need to comply with the code. You want to think about the sun's orientation to that site. You want to think about the area of that new bedroom, and achieving that will then sacrifice those square meters from a different purpose. So how do you do that in a way that doesn't compromise the overall livability of that space or that home? So this is the floor plan from before. So we have this typical, you know, whether you know a property or you own or you're looking at a property that has this sort of angle on it or not, a very common existing house footprint has this layout overall. Bedrooms down one end, kitchen, dining, walk through to the lounge. And in this case, it's not just the layout, but you want great generous proportions in those living areas. Because if you want to steal an area to create an additional, or in this case, fourth bedroom, the residual space between that kitchen, dining and lounge needs to be sufficient for how many people and bodies will be living in that place. The other most important thing is that the way you change that layout of the house and where you put that bed needs to be appropriate for the most likely tenant. Again, you need to have a professional manager. Property managers get their feedback on what the before and after rent might be, as well as is that layout appropriate for tenants' expectations for that location. This is probably a really good example of one of the most common ways. But what I would also say is that you need your builder to comment on making these changes is either going to be non-structural, which means you can get on with it without needing to get council involved and get building consent. If it is structural, Sometimes this wall can be, just depends on how that property is built, that house is built. You would then need their professional opinion as to whether you need a building consent. If that's the case, then that will lengthen the timeline and your holding costs on the renovation. But as you can see here, again, just going to the before, my clients have created more of an open plan feel. They've done a fantastic job at modernizing the look and connecting the kitchen to the living and dining space. And it was a really generous space, as you would have seen. They have started by adding this 4th bedroom, and in that before photo, you can sort of see a hint of the kitchen, but you can see that this opening in the wall between this vantage point of the living room, that corner to the right, you've got this quite open, generous space. The kitchen was absolutely dire. We didn't even have many before photos because it was just so horrid. Basically, everything was being completely ripped out. So that really opened up the opportunities for how our investor was going to work with this property. Now, when you have a space between the dining on the right and the kitchen to the left, you have a lot of flexibility as to where you're going to pop in those additional walls that form the room. In this case, the kitchen needed a complete and utter replacement. And of course, we then decided to reorientate that back to this lounge. That meant that the wall or that partition between those windows you see could be quite flexible. And the other perpendicular wall basically helps you work out that area. As an adult bedroom, you need legally a 6 square metre area for that room, and the window needs to be at least 10% of that floor print of that room. So on both counts, we're in advance of those minimum parameters. You see that photo to the right really works as a bedroom. You need to make sure you have enough wall space and area for furniture, and it works really, really well with the orientation of the sun in this site. As you can see, they completely upgraded the kitchen, and where they in fact closed up a lot of that opening in the wall looking through to the previous dining, they were able to close that in and actually reallocate some of that load across to the kitchen instead, which was actually a narrower opening than before, and that allowed them to completely reshape a modern functional kitchen. Along with that, and just to comment on that, adding the bedroom is by far the most critical. That really is the core of the process. So if they had bought a property that did not allow this, you can see in that photo to the right, that door to the left is that additional bedroom. That makes total sense for the type of tenant and how a family wants to use that room. Also, coming back to post-COVID, a lot of additional rooms are used as offices, work from home. There are so many different ways. Again, it comes back to what your property manager says is the most likely need or purpose, and creating a home that works in with what's expected. Any thoughts on this, Kim?
That's good. You've done a good job.
So when you look at this, when one of the best places or the 2 best places you can look at in advance of talking to a professional property manager for feedback on rents. The first one is Tenancy Services, which is the government website for all of the tenancy bonds that are registered, lodged. Looking at a 3-bedroom rent, it's pretty clear to see this would be on that lower end, that lower quartile rent. But if you look at those stats and you say, hey, I'll cosmetically improve this house and turn it to the best 3-bedroom rent, it's only going to move so far based on what the market will pay. But in this case, buying the property that they could add the 4th bedroom to, not only shifts it from a lower quartile rental to higher, but it nudges it right up a rung into the top of that 4th bedroom rung as well. So a few shots of that after, you can see that, this is not a new build on the outside, but it really looks like one on the inside. So in all intents and purposes, when you're on the rental market, this is the newest house in that location on that day, all day, every day, we're up in that upper quartile rent for the 4-bedroom. The second place I mentioned is obviously asking rents with Trade Me. That is your more accurate data on top of the government bonds data, because that is up to the minute. There's often a 6-month lag in the bonds data. And on Trade Me, you can have you can track what the asking rents are. Always land them in ascending order of condition. You can think about, again, relativity. Where does your rental sit with respect to the 4-bedroom that has a pool? Well, you probably can't assert the same level of rent. So that's your ceiling. It helps you look at real data, have a look at how quickly those rentals are turning over, because the market is softer than we have seen for a number of years. Definitely temper your figures, be conservative on those rents. But when you create a product like this, you absolutely are cutting above the typical standard. Now, why will executing a renovation like this, cash flow hacking and adding a room, enable them to move forward? In this case, they popped in that deposit as their own cash rather than purchase their own home. The renovation, which did include quite a lot of external painting and tidying up and landscaping, a decent amount of exterior repaint and fixing of windows and things, but largely otherwise focused on that internal. That's the amount of capital that needed to go in to get the job done, to create those after photos. Oh, what's happened here? Just try and move that along. Here we go. Post-renovation value, so a registered valuation is what they got. And this renovation, by the way, thinking about those salaries, they both work full-time doing these awesome jobs that they do for a couple of large New Zealand businesses. And if you think about this as a result, a registered valuation on this property, $970,000, it's a $150,000 equity gain. The length of time that this renovation took was 5 weeks. So fast. So divide 150 by 5, they made $30,000 in wealth or equity per week. The power of doing this alongside having great jobs, not to have a view of replacing that with this. This is so powerful, this being alongside what they do day to day and what you could be doing day to day, really supercharges your results towards your ultimate goal. It's amazing, great result. So just to show you the comparison of why add value or get left behind, right? If they bought this property and not added value, the condition it was in, it was owner occupied previously, the median rent for that 3-bedroom was around about $600. I honestly think that was quite generous. And if you think about that, without adding the value, without adding the room, first of all, who would want to tenant that property? But there's no way that that would be a strong rental, strong demand and strong cash flow. But as a result of what they did do, they've created $150,000 of additional wealth. Well, they've leveraged completely other people's money, the bank's money, and other people's time while they were at work to create that fast-tracked wealth over 5 weeks. So on the debt that they actually had in there after popping in their cash for the deposit as rent investors, they created over a 9% gross yield on that debt in central Auckland. And that's, if we think about the property clock, that was about 4 o'clock. It's incredible. So if they had bought this and not added value, this is a really good point to push, really. If you think about that existing build, which is more affordable than the new build, right? And if you look at any location, we're talking about discounted product. It's a second-hand product. So why not take that opportunity to buy at discount, invest a little more where you can, or structure your lending with your advisor where you can to create this on the right. So positive cash flowing rental in Auckland. So the so what though, adding value, any thoughts, Cam, on what they did here?
Oh, I just sit back, and it doesn't matter whether you look at residential property, commercial property, the equity market in general. The next 10 years I think is going to be a lot different to the past 10, 20 or 30.
Yeah.
And one of the big themes going forward has got to be just about extracting, adding value. You've got to be a lot more active as opposed to passive with your investment strategy. Passive stuff worked when interest rates trended down over 30 years. That story's over. So people have got to be a lot more active within their management approaches.
Is it fair to say though that, okay, so if someone didn't need to or didn't have the inclination to want to boost the cash flow as much as the strategy might suggest or offer, you could still hold property for time, right? Over time there'd be some wealth creation, but you're sort of suggesting that the historic rates are higher than what we will expect to see going forward, and just wait longer.
If we see house prices grow at 7% every year like they've done for the past 30 years, I think we've got a social crisis on our hands, right? So I just don't think it's going to take place. And the government's obviously working pretty hard to make sure that we see a lot more what's called sustainable growth in house prices, which is that's what we want.
Which is what you want. You want a balance.
We actually want a market that's fully functional, and you want people that get out there and do the work and take a bit of genuine risk, you want them to get rewarded as opposed to those people that just sit there and clip the ticket. And then with the passive sort of stuff, I'm not a big believer in passive.
Right, and also
investing.
like this, and this is what this is doing, right? So creating this enabled in 5 weeks, that registered valuation was literally 5 weeks later. And this is, oh, hang on, here we go. This is what it did. This is what it did for them. Okay, so rental number 1, you know, they had the lending there, they put cash in. So what we're showing you here is that $730,000 purchase in Otahu. The debt on that was $511,000. Okay, so if they hadn't created that $970,000 new registered value outcome 5 weeks later, what, 5% maybe on average year by year, okay? So I don't know what that translates to in exact years, but rather than buy the next one after 5 weeks, it would probably be more like 4, 5, 6, 7 years, something in that scale, right?
Yep.
So either buy the next one in that period of time. I tend to think anyone who wants to look at these sorts of case studies is not willing to wait that long. And, oh, where are we? If you think about then, this is the whole purpose, right? So to move forward, you look at this new value, 970. The new 70% value of that, oh, where are we going? Is 679. So 679,000 is from a 70% LVR point of view. The bank, if your servicing supports, the loan to value ratio allows you to draw down up to 679,000. So that value minus the 511 gives you a $168,000 top up. So the whole concept of the BRRRR, which is, I guess, cash flow hacking is in that camp, right? So buy, renovate, refinance, rent, refinance, repeat. Income comes in, go back to the bank. Thank you, it's worth this. Let's refinance up to that new level. We get $168,000 to draw down. Thank you. That now becomes effectively 30% of a new purchase. And literally a month or so later, these same investors went again. So not only do they have this cash flowing property, they've now drawn $168,000 out of it 5 or so weeks later. And they've bought number 2 in Favona in central Auckland. The purchase price of this one was $740K. The difference, if you think about this, is that this is all mostly debt. So that 168 deposit coming off Otahu, that is debt. So there will be interest against that, cost against that. And then the purchase of that property is debt through a new lender as well. So slightly different scenario, but the takeaway with this concept and with them starting as rent investors is that they started with cash. So the 30% upfront was cash, and that is what enabled them to have stronger cash flow, which then moved into this one. Now, I won't go into the full project details of this one because the actual outcome on the main build, the main dwelling itself was quite similar in terms of layout. But this was one that no main banks would look at to begin with, and it did start off it was settled with a second tier with a very clear plan. We had a contract for the construction works, very clear costs on it. But what was unique, and I think this is important to point out because again, this second one was mostly debt, unlike the first one, right? So if you think about more debt here, there needs to be an X factor or something that once you convert this dining room to the left became a 4th room in this case, absolutely appropriate here. But there was this fairly rundown but great, huge external rumpus converted garage with these 2 other rooms. It was probably about 70 square meters. It was gigantic, relatively good interior condition. Someone had previously done a really good job of it. But more the exterior was a bit worse for wear, not so weathertight, and to be part of a rental property with these additional rooms, we actually needed to just protect it a little more. So knowing that this would have more debt, we needed to create more rent. These additional features, or if you say up spec, these additional rooms really allowed a larger family. We got a small consent to get a second toilet to really make sure that this whoever moved in here would have all the facilities they needed comfortably. 7 weeks later, this is the result. If we go back and look at this property that no bank wanted to touch, this is incredible. So they, our builders came in, really reinforced the front, finished off a build that should have been done correctly, that wasn't done that well previously. And this is now renting for nearly $1,100 per week. So a 3-bed becomes a 4, plus a couple of extra rumpus rooms, larger family, 2 bathrooms in there, 2 toilets, and because of those additional rooms, that allowed a really strong cash flow that again ends up positive. So looking for that X factor with the confidence and the skills and the knowledge and the budgets that they'd learned from the first, the results on the cash flow are near identical, which is why it's more just to show you that before and after. The power of what they've achieved is not just those 2 holds in Otahu and Favona, but they've actually, as a result of the top up on Favona, their second rental, the deposit from that completely covered the deposit needed for what they are cracking into right now, a flip. So buying a property, they've bought a property in Dunedin, they are mid-renovation right now, and this has been completely funded by properties 1 and 2. If the scenario had been that they were leveraging off their own home, the cash flows would have been slightly different, obviously. And, I guess there's a reassessment point at each end or each conclusion of project 1 and 2. What they've done is really set themselves up to get into a flipping strategy. They've established 2 great rentals. They've addressed the maintenance. They've created these great rentals with additional rooms and great cash flow. If they choose, who knows what comes next? They might sell that, use the proceeds to just start paying down debt, or they might continue to copy and paste on the flips. The cash built up from that would then allow them to put those funds as deposits into maybe rental number 3. Have you done this, Kat? Have you been as active as this? They're so active. This is all within 12 months, which is just incredible. Really impressive.
Cool, nice.
Yeah. So, hey, appreciate time's getting away. So before we go into a few minutes for Q&A at the end, just want to highlight and take you through what each of us does. So first of all, Cam, do you want to talk through how your subscription works and what you run through is it Sunday?
Oh, every Sunday, or it might be the occasional Monday, but there's a 15-minute sort of bit of a, wouldn't say it's a bit of a rant, but it's a bit of 10 charts. This is what I'm seeing over the week, what we're seeing around the globe, what we're seeing across New Zealand. So yeah, feel free to dial in at sort of 8 p.m. if you just go to my website, bagrieeconomics.co.nz, and there's a wee subscription thing there. Just a small bunch of people sort of dial in and we have a little bit of fun.
Awesome. Cool. Speaking for Wolf Property Coaching, as you would have seen in these examples, all about adding value. I think it's pretty clear what we're not here for, sitting on the fence and waiting for things to hopefully work. We're all about action and being in charge, achieving great gross returns through adding bedrooms, renovating, building usable equity, as you've seen in this example, and really determining outcomes. We can calculate post-renovation rents using our power teams and our experts on ground, whether you're in Iceland or Australia or in Auckland. If you're purchasing in Christchurch or Dunedin, it doesn't matter how removed or remote you are, it's all the same, right? So we have all of our teams on the ground to execute. Even with some clients I have who are builders, initially they think they'll get involved, but they usually find it's good just to lean on the power team. So being able to do this with complete confidence on a proven methodology, much like what you've seen here, really gives my investors around the globe comfort to execute on proven results. And as everyone probably knows, I don't like being told I have to choose between yield and capital growth. So I just want everything for my clients. If you work with us, obviously, through Accelerate is on a single project basis or on a 12-month basis. I would say 98% of my clients are on 12 months, and that tells me they want to copy and paste what has been shown here, at least 2 projects over that time frame. So here for it. It's unlimited access to myself. It is myself, one-on-one coaching. Again, nationwide power teams. I'll show you on the map shortly. They are from top to bottom. We're always looking to overlay the strength of long-term capital growth and all those great fundamentals such as positive population growth, diverse employment, and migration trends. That's your wealth portion, and then creating those strong returns, working with our property managers on ground in the markets to assess what's in high demand, low supply. How do we really tap into these specific dynamics in each place to create a high-performing rental for you and get rid of the disgusting mouldy properties that are around the country and turn them into wicked healthy homes. We have regular whips on Zoom to bring everyone together very regularly. by virtue of being remote. It's great to help investors everywhere, but it's very hard to get together oftentimes. So we do have regular Zoom-based catch-ups with case studies and guest speakers. And then we have also the on-demand education portal, which is a lot of the theories and examples and previous case studies. So a wealth of information there that you can dial into. But the most important thing really is bringing together like-minded investors such as yourself. Hanging out with the right people is absolutely key, with the same mindset to progressing your own success within this world for sure. So one of the most exciting things, we've just booked our next date for the 23rd of May. These Reno Roadies are truly the most immersive, incredible networking, technical learning, going through a bunch of renovations from standalone properties up to big multi-units. This is the most recent one. I think we had 27 different floor plans, and there is a ton of work creating wealth and cash flow for these investors here. So honestly, some of the best parts of what I love about this business and my clients is being able to spend these days together. It's truly, honestly, part of the best part of it. As I say, we have power teams. We've got you covered if you're here or if you're logging in because you're global. We had clients fly in from Spain to that last slide. They came to our roadie, and it just shows you that they can get amongst it when they're here, but when they go back to Spain, it still continues on with the people that they've now met and can trust on ground. This is a really cool photo from the actual first case study, amazing clients and our power team. Thank you also to AJ from Lighthouse Financial, who sorted all the lending, especially on number 2, where the banks just did not love that first property. And like my clients, he hustled to get them the just the best result to enable them to keep moving forward. And I'm very pleased and proud of them, honestly so proud of them. Makes me feel quite emotional. They're about to move into a whole nother stage of their life, and honestly, they've just created the most strong foundation for themselves and their family. So tomorrow we'll send out an email. You're absolutely welcome to book in a call, here to answer your questions for the next few minutes, and then we'll let you get back to your valuable Wednesday night. But thank you so much for joining us. I'm going to jump into the Q&A. Let's have a look at what we've got here. We can probably fit in about 4 questions, I would say, and then we will pop them all out on the email tomorrow. So let me just see what we have here. I want to make sure everyone's getting their questions in front of Cam first and foremost. Is your prediction that the 5% 1-year special rate will be the low this year if we get to 3% OCR?
Yeah, I think we're pretty close to the lows in interest rates at the moment, but you need to differentiate between the 1, the 2 and the 3-year rate versus the 4 and the 5, because the 1, the 2, the 3-year rate is being influenced by not just the official cash rate, but expectations as to where the official cash rate will be in the coming 12 months, which is basically 3%. But if you look at the 4 and the 5-year rate, those rates have been far more dictated by what's going overseas, and particularly in the United States. And because the United States has got a little bit more of an entrenched inflation problem, and there's the impact of tariffs, which could add to inflation. We've seen what's called the back end of the curve. Those longer term rates are above the short term rates, and I think that's going to persist for a while.
Okay, thank you. Okay. Let's see what I've got. I want to make sure we cover off these lending questions. Oh my goodness, okay. Here we go. Let's see what we've got here. Add a bedroom. Okay. Let's go into these. A few questions about adding the bedroom. So all good. If you add a bedroom and don't need consent to do that, how do you ensure the bank will value that as a 4-bedroom house? Really good question. So it's not about the bank coming in. The bank will lean on an independent registered valuation from a registered valuer. So this is not someone from the power team or on, I guess, our side of the application suggesting the property in the first example was $970,000. This is an independent registered valuer, which is regulated, comes in and says, hey, look, let's look at the market sales now that it is a 4-bedroom property. Let's have a look at what 4 bedrooms are selling for in that immediate location and comparing condition and what they have to offer, floor size, land size, district plan, all these different many factors. And basically they assert that if you were to pop that on the market, it would sell for $970,000. The bank takes that as a new valuation for that result for the property, and then they allow you to, if you meet the criteria, leverage that up to the 70%. So that's how that works. How do you avoid hitting a lending ceiling, or is it inevitable? Okay, so is it the norm to buy a couple of properties and then get stopped between 2 and 5? I see this all the time. Effectively, there is no single answer, right? It's a function of if you have ambitions to grow a large portfolio, if that's the case, you're constantly having to seesaw and balance servicing and income against the other factor that the banks care about, which is your usable equity, or the equity or cash you might access to support them giving you a loan for the next one. Is there anything you'd add to that?
Yeah, well, the debt to income
Oh, of course, and debt to
restrictions that have
income,
been
yes.
brought in, what can you leverage up to, 7 times your income at the moment? And
Yes, rental income from existing builds 7 times, whereas again, reinforcing that concept in this case is 6%, 6 times for your own home.
but you might be able to throw in your own equity up to a certain point, but eventually you're going to run out of runway, right? Because it'll catch you at the end of the day, right? So the key here, once again, is to make sure you got the income coming in from that side of the asset, because the borrow and sort of accumulate wealth through that sort of angle, that's going to be tough. Going forward, the DTI restrictions have been put in place to stop a lot of that stuff.
And that's accounting for all of your gross income. So that could be commission, salary, self-employed, rents, all of it is bundled up. The bank will have their own policy on how they assess or measure or scale each of those incomes. They're not all treated equally. But when you receive the email tomorrow, we'll also have a link for you to book in if you need some lending advice, and with the Lighthouse team, they'll be able to support and assess your situation as to what you might be able to do. But Cam's right, there's going to always be this balance of either your income needs to catch up to meet your ambition to buy the next one, or vice versa with equity. And it's an ongoing, that's why with this strategy, we're constantly trying to boost both to best effect. And a higher gross yield translates to a higher gross income to help you along that journey. Awesome, we'll take one more. Let's say, what have we got here? I'll just see if there's another lending one, because I think you're all really interested in that. Do you have a PAL team based in Christchurch? Yes, we do, absolutely. That's one of our key areas. And then do you take on anyone, or do you have certain amount of spots for each month? Yeah, so definitely spots are limited. This example is focused on Accelerate, which is standalone houses, sometimes home and incomes or double income properties. The other service we offer is Boardroom, which is 3+ incomes, which we haven't covered off tonight. That's a separate service. Definitely check out on wolfproperty.co.nz the 2 different service comparisons there. Boardroom requires typically some experience, because it's a whole different methodology, more technical, larger risk, larger scale of properties, and therefore debt, so it's a slightly different kettle of fish. With Accelerate, we have monthly onboardings. So from May, we will have set dates which will be published on the website, and so it will become up to you as to when you're ready to slot in once you have your lending. And if you're wanting to work with us, elect the onboarding session that works for you, and then we'll move straight into you being on the market for your first either single project with us or kicking off your 12 months. Well, thank you so much. Is there anything else you'd like to add as some parting comments? Otherwise, I want to say a huge thank you for you coming in to meet with us and up from Wellington.
Oh, it's nice to get up in Auckland. Just a shame that the weather wasn't a little bit better. Normally you come up from Wellington, you kind of hope the weather's going to be a bit better up here in Auckland.
You're looking for the upside, yeah.
Maybe it'll be better on Mount Maunganui tomorrow.
Well, thank you all for joining us, and I hope you took some inspiration, feel more wise about the market under Cam's guidance. Do check out his website, of course, so you can get regular updates with him, and look out for an email tomorrow, which will have a replay and also all of the questions answered. But thank you so much for joining us on your Wednesday night. We'll catch you next time, and it won't be so long next time. Cheers, have a great night. Thank you.